right? We can actually be neutral with options and profit off of that. We can profit off things like time decay, volatility contraction, expansion, which is just not possible when we're thinking about individual stocks, whether we be buying or shorting those stocks. So that's what we're here to talk about for the next 4 weeks. And you're going to see basically the following agenda. And this one is actually separated out. We have included that in our options intermediate class because that's where we're going to delve into the Greeks. So that's not really a part of this one as much. We will talk about things that affect pricing on a more holistic scale in these 4 weeks. But as far as the Greeks, we don't really delve into that a whole lot in this intro class. But the above four, so looking at the four items above here, we're looking at introduction options. That's this week. Next week, we'll be talking about buying options. We mainly focus on buying calls, buying puts. In week 3, we focus on selling based strategies, primarily selling cash covered puts, selling covered calls. And then in week 4, we talk about options trade management. So things that we need to be thinking about prior to the trade, during the trade, and then at the end of the life of the trade. Also about exercise and assignment, even though, again, we'll be talking a lot about those concepts throughout the 4 weeks, but we really focus in on it there in the last one. A couple other things that we'll just start on just for administrative purposes. So I've already noticed some of you have started to use that Q&A feature at the bottom of your Zoom window. We want you to use that. We want to make this as interactive as possible. We want to answer questions. We know there's a lot of information that's going to be thrown at you in these 4 weeks. And if you do have anything that pops up, please feel empowered to use that Q&A. We want to answer those questions along the way and be addressing them, as well as we might need symbols from time and again. So feel free to throw those in there on occasion. Though a lot of this class is actually slide based. We like to also make it a little bit more demo based as well towards the back end of most of our sessions and look at some real-time data and real live examples as we go along. All right, with that out of the way for the agenda, let's talk about briefly here where we can get some of our information about the class. So a couple of things that I want to cover. So one of the most common questions that we get asked is, hey, if I miss a class or if I want to go back and review something, is this class recorded? And the answer is yes and no. So while this specific class that Albert and I are going to be doing today is not recorded and published on the website, we do have a version of the 4 weeks that is recorded and published, and you're seeing that right here. Easiest way to get there is actually if you just go up in the top where you just go into your little search bar on fidelity.com. If you type in the following words, options trading at Fidelity, if you type that in, it'll bring you up to a list of results, and that's the one that you're looking for. For whatever reason, it's not the one on the very top. It's about 4 or 5 down. But as you'll notice here, we have sessions 1, 2, 3, and 4. Those are the 4 sessions that we're going to be covering here in the next 4 weeks. You can also see that they're a little bit shorter than an hour. That's usually because we do actually have questions that come in throughout these sessions, and that's what takes us a little longer in these. However, you'll also notice that there's actually a 5th and 6th session, which now we've kind of broken out and included in that options intermediate, but you can see part of that class or part of those sessions right here as well. So that's how you would get there. Again, just search options trading at Fidelity in your search bar, and that'll be one of the results. Finally, if we go over to fidelity.com/classroom, so if you just type that in your URL, that'll take you to the following page. If we go to our options for beginners class, you can click on learn more and register, which probably all of you have already done. That's how you winded up in the class with us today. However, if you go there, just want to highlight a couple of things. So if you're looking for the slides that we're going to be using throughout the 4 weeks, you can get those right here where it says download slides PDF, and that one PDF is going to have all 4 weeks included in it. As well as you'll see there's a little line underneath each and every week for the first 3 weeks. And the reason for that is if you click on that, it'll launch a separate PDF. It's going to have a little bit of homework or self-assessment, whatever you want to call it. We'll cover that at the beginning of the following week. So in week 2, we'll cover week 1's homework. It takes about 5-6 minutes to actually go through and complete. And it's really just a give you a barometer for did I retain most of what I was intended to retain from the class. We don't check and see if you did it, of course. We just go through it at the beginning of every class. All right. That's pretty much it for the administration related items. Albert, glad to be with you. Albert is one of our most experienced options people here on the desk. He was a market maker for a long time in Chicago. And, he has a lot to offer and bring to the table when it comes to these discussions. So glad to be here with you. I want to give you a chance to say hello. And if you want to go ahead and kick us off for week one here.
Yeah, thanks, Matt. Appreciate that. As Matt said, I've got a background in options. I spent most of my career on the trading floors here in Chicago, so I enjoy talking about options just as much as Matt does. So glad to be here and glad to kind of get started with some interesting things with regards to options and really kind of how we can get started. So I'm going to go ahead and kick us off. Let me go ahead and grab the screen real quick here, Matt, and we'll start diving into some of the agenda for today. In fact, let's just talk about that real quickly. We'll talk about, what are options, just really a basic understanding of what options are. We can talk about the anatomy of the option symbol. This is really for your information. There are ways with the tools that Fidelity has. You don't actually have to know this, but it's always good information to know. We'll, of course, talk about exercise and assignment, probably one of those things that a lot of people is the first thing on their mind with regards to options. And finally, we'll talk about some strategies for trading options. So that being the case, let's go ahead and dive in. What are options? Well, we could talk about options that are really a contract, right? That gives buyers rights and sellers obligations. So buyers' rights, sellers' obligations. Well, what do we mean by that? Well, let's take an example, right? A buyer's rights. You can choose to buy or sell 100 shares typically of the underlying security up and until the expiration date. You can choose. That's the right to do that. You don't have to do that, right? You could let the option expire. Maybe you just choose to sell the option itself, but that completely up to you whether you do that or not. That is from the buyer's perspective. If you were to be long an option, whether it be a call or a put, if you're long a call, you can choose to buy 100 shares. If you were long a put, you can choose to sell 100 shares of the underlying security up and until the expiration date. Um, where does it happen? Well, it happens at the strike price. So if we're talking about a 100 call, then you have the right to buy 100 shares of the stock at 100 up and until the expiration date. For this right, the buyer pays a premium or the price. In other words, we pay for that option. We buy that option. We pay out that premium. However, the upside to that is that that's our risk. That limits our risk. How does it limit our risk? Well, we can only lose the premium that we pay. If we pay, $3.25 per contract or a total of $325 for one option contract, that's what we're risking, $325. If things go awry and go against us, our loss is $325, which is a lot different than if we were to buy 100 shares of the stock, right? The stock could technically go to zero. So when you buy a stock, technically your risk is it goes to zero and you lose your full investment. With an option, the premium that you pay is the risk you're exposing yourself to, whatever that premium might be. That's an important distinction to be made. I did see a question that came up with regards to options and risk, and so this is really the way I would address that, Scott. And if you are talking about, avoiding risk because options themselves, can entail risk, and we'll get into that a little bit more. But just out of curiosity, a show of hands, how many people have heard that options are risky? Right? That's one of the first things you hear about options. And yes, it can be true. They can definitely be risky, but there are ways to do it so that it's not as risky. And one of the ways to do so is to be an option buyer. By being an option buyer, you're limiting your risk exposure. You are letting yourself know, hey, this premium that I pay, that's my risk. It doesn't go beyond that. Now, on the other side, we've got seller and their obligations. As a seller, you're obligated to sell or buy 100 shares of the underlying security when called upon up and until the expiration date. Again, this happens at the strike price. And for this one, you receive a premium. Now, what is the inherent danger to being an option seller? Well, if you're short an option, in other words, if you're selling a call, for example, that means that at some point you'll have the obligation to deliver shares to somebody if they choose to do that. So that means that, let's say you don't have the stock in your portfolio. What does that mean? Well, that means you have to go out and buy it and then sell it at the strike price. So if you sell a call, let's say you sell a call, a 100 strike call when the stock's trading at 90. If that stock goes to 200 before expiration and you don't do anything, you have to go in and pay 200 to buy the stock and then turn around and sell it to that call buyer at 100, instantly locking in a loss. Why is this risky? Well, stock could go as high as it wants to go, right? Technically it could go, infinitely higher. We can't even quantify that. On the put side, if you sell a put, it's the opposite, right? Now you've got the obligation to buy it from somebody. Well, what if you sell that same 100 put when the stock is trading at 110, and next thing you know, the stock's trading at 50? What do you have to do? Well, you have to buy it from them at 100, and then you have to either hold it or turn around and sell it at 50. Either way, it's not in a good position. So buying versus selling is one of the key differences of risk. When you're a buyer, you're paying that premium and you have a right to do something. You limit your risk to that premium. If you're a seller, you have an obligation to do something. You receive a premium for taking on that risk, but it doesn't end with that premium. It could be substantially different by the time expiration rolls around. A couple of things I want to point out on this slide before we move forward. You'll notice that on both of these, it says typically in parentheses. A standard option contract covers 100 shares. There are situations where you could see an adjusted option, maybe because a company spun off a component and gave you a right to own something within that company, that spinoff. Could be another reason. But the point is, if you ever see an adjusted option, make sure you know what that adjusted option is. It could cover 100 shares of XYZ plus 25 shares of ABC. Make sure that you understand what that adjusted option is before you start trading an adjusted option. A standard option contract is 100 shares. So do keep that in mind. That's my public service announcement for the day. On the service side, I've taken calls where people didn't know that, and it hasn't been a fun conversation. So limit yourself to that risk by understanding that an adjusted option is very different from a standard option contract. If you ever have a question, you can always go to the OCC.com. That's THEOCC.com. That's the Option Clearing Corp. They have all kinds of information about adjusted options, specifically adjusted options. So use that resource as well. Also, when we talk about the exercise style here at the bottom, key distinction to make here is the American versus European. This comes into a factor when we're talking about early exercise or something like that. An American style option, typically a single name stock, is an American style option, meaning that at any time but up until expiration, you could exercise it early. When does that come into play? It doesn't happen too often. Most of the time, when you see an early expiration, it's typically when you have sold, say, a covered call and there's a dividend being paid. If that time value is less than the dividend, people will go ahead and exercise so they can get the dividend. So that's an example where that could happen. Typically, there's time value in an option up until the last day. So unless there's a particular reason why someone would want to do that, it doesn't happen all that often, but be aware that it could potentially happen. On the European side, those are typically index options. Those are only at expiration. So again, they don't have that kind of early exercise aspect to them that an American style option would have. All right. So why trade options? Well, again, I think that we talked about this kind of briefly, but I do think it's an important distinction to be made, and that's risk management. If you have an individual security in your account and potentially you're looking to maybe protect that security for the short term, maybe you think that coming into earnings season, you're a little bit nervous about the earnings, so maybe you want to purchase a put just in case the earnings do disappoint and the stock heads aggressively lower. At least you have some sort of protection on you by buying a put. And the other thing is less money out of pocket. We talked about this, right? If we have a stock that's trading at 100 and we want to buy 100 shares, well, now we've got to put out $10,000 as opposed to maybe buying an option, which maybe we put out $300 or $500, something along those lines. The point being is that when we do put out that cost for that premium of the option, that's our risk. When we buy the stock, it could potentially go to zero. If we're long 100 shares and the stock goes to zero, our investment is gone. If we are long a call and the stock goes to zero, we only lose the premium that we paid for that option. So that is a big part of why people will use options. Yield enhancement can certainly help improve the returns on your securities. Let's say maybe we're in a scenario where the market's kind of moving sideways, or maybe you have a stock that's really range bound in a tight range and not doing a whole lot, but you want to try to generate something out of it in the meantime. So maybe you sell a covered call. Hopefully, you take in that premium. The option expires worthless. You get to keep your stock and you can do it again. That is certainly a way people will use options to help improve their overall portfolio returns as well. So certainly yield enhancement is a valid reason for trading options. And of course, leverage. This goes back to the same one before. Less money out of pocket. You can control 100 shares with one call option for a lot less than the actual price of 100 shares. And it gives you more choices, as Matt pointed out in the very beginning of this presentation. Using options can give you a lot of different ways to, uh, you know, make or take positions on an underlying stock, and not just on price. It could be on a variety of different things as well. So certainly the ability to use leverage. Of course, leverage can cut both ways, right? We know that being able to use it properly is a very important aspect of trading options as well. So understanding what it is that you're doing before you do it is going to be crucial to making sure that you're successful with options. You don't want to just start up a chainsaw and start cutting unless you understand the potential situation with a chainsaw and how it can harm you. Same with options. If we take a look at stock versus options, I think this is probably one of the things that is the most important, because when we talk about stocks, right, the first thing we'll talk about is there's a substantial risk of capital, right? That stock could go to zero technically. We don't see it that often, but it could definitely happen, and we shouldn't be ruled out. It's a risk to consider. The one thing we do have is a lower break even. And what do I mean by that? Well, when we buy a stock, we pay that price, and that's really our price, right? If we pay $100 for it, if it goes to $101, we're a dollar in the money. If it goes to 99, we're a dollar out of the money. The break even is the price that we paid. We also have voting rights. If that's something that's important to you, you have access to the voting rights. It does not happen with options. Potential dividends. I mentioned that before. That could be something to think about. If you have that stock, you get to have access to that dividend as well. But really limited strategies, right? When we talk about stocks, it's relatively one-dimensional. It's up or down. So obviously, we can buy it, we can sell it short if we wanted to, but that's essentially all that we're going to be able to do with a stock. When we talk about options, well, now we got a different way of looking at things. We certainly have leverage with risk limited that premium paid, right? So in other words, we don't have to worry about it going to zero. All we need to worry about is losing that premium that we paid. We do have a higher, lower break even. And why is that? Well, for example, let's say we're going back to an example of a $100 call that we paid $2 for. Well, in order for that to be a profitable situation for us, we would need that option to go up and above $102, because we have to offset the cost of that premium that we paid to own that option, right? So that break even's a lot different than it would be for an individual stock. And that individual stock is just the price paid up or down. We also have to consider the strike price as well as that premium we paid on options to give us that real true break even on that position. Limited life, it's a decaying asset. Again, when we talk about stocks, it's pretty straightforward. It's up or down, it's one dimensional. When we talk about options, it's a completely different story. This is more three-dimensional. We need to be concerned with not just the underlying price, but we also have to be concerned about the timed expiration. How long does that option what's the lifespan of that option? And then we also have to be concerned about volatility, because that volatility component, while a very complex topic and outside of the scope of today, is going to have a lot of impact on the price of that option. So we can't just look at it from the standpoint of the underlying moving up or down. We have to consider the other two as well, because they will play a major role in determining whether or not that option is profitable. No voting rights or dividends. This is not, you're not buying an option because you want to participate in voicing your opinion about where the company should be headed or receiving dividends. That's not what this is for. But again, many strategies, right? Options give you options, so to speak. You have a variety of ways you can play things. It could be from a price perspective. It could be from a perspective of timed expiration or volatility as well. So there's a variety of things that you can choose to express your opinion by using options themselves. So, as an option buyer or seller, you can either be a buyer or seller. And we've talked about a lot of these things, but again, an option buyer, you pay a premium or the price of that option. You have the right to exercise and buy or sell 100 shares of the underlying security, whether it's a call or a put. also called a call or put holder or long the option. So if you hear someone say, I'm long this option, that means they bought that option. Um, Again, substantially different than being an option seller, right? An option seller, they receive that premium or price. They have the obligation to buy or sell 100 shares of the underlying security at assignment, or again, that early exercise. Also called a call writer or put writer, short the option. Hey, I'm short this 100 call. That means that they sold the 100 call. So we can talk about a variety of different ways to describe it, but just understand that option buyer and long the option go together, and option seller and short the option go together. And then finally, I'll do this one last one, then I'll pass it to you, Matt. But here's a basic grid of options, the very basics. And what I mean by that is we've got two different types of options. We've got the call and the put, right? And so a long call, allows the option holder to buy 100 shares at the strike price up into the defined expiration date. Again, said to be long the call. If we are long a call, what are we? Well, we're bullish, right? We're hoping the stock goes up. We're hoping that our option becomes more valuable. We are definitely bullish. What else is bullish? Well, a short put is bullish, right? The short put is the obligation to the option writer to buy 100 shares of the underlying at the strike price when exercised. So we're selling a put. We want to be short the put. We definitely would hope that the stock would go up. The last thing we want is for the put the underlying to actually go below our strike price, and then we are on the hook to buy shares at a higher price. So a short put is bullish as well. We are hoping that it goes up. The only difference here, right? On a long call, we're paying that premium, defining our risk up front. On a short put, we're selling first and bringing in that premium and leaving our risk a little bit more open-ended. So again, getting back to the whole idea of risky versus non-risky, if you have a bullish opinion and you want to be a less risky opinion about it using options, your choice would be having a long call. If you are looking to get paid now and worry about that risk later, well, then you could be a short put, but they both are definitely bullish. On the other hand, we have the long put. This allows the option holder to sell 100 shares at the strike price up to the defined expiration date. You're said to be long the put. This is definitely bearish because you are hoping that well, I should say, you're thinking that the stock could potentially be going lower, and you want to be able to sell, a higher price stock. And this, you're hoping that the stock moves lower and your put is worth more money. That's exactly what a long put is. Again, you're paying that premium and you're hoping that the stock goes lower so that at some point you'll be able to sell that put or even sell the stock at that strike price. So what else can you do if you're bearish? Well, you can have a short call. This is it obligates the option writer to sell 100 shares of the underlying at the strike price when exercised, said to be short the call. So when we talk about risky, if we want to talk about the riskiest possible position you could have, it would be a naked short call. What do I mean by naked? You just have a short call and you don't have the shares to cover it. What do we think about when we think about selling calls? Typically, we're talking about selling covered calls. We own 100 shares. We sell a call against those 100 shares, knowing that either we'll keep the premium that we brought in for selling it, or at some point we may have to sell our stock at that strike price if it does go higher. If we don't have stock backing up our short call, where could the stock go? It could go theoretically infinitely higher. And we would have to at some point buy that stock back because we are obligated, remember, to sell that stock. We would have to buy it back at whatever price and sell it at the strike price. So, again, if you have a bearish opinion and you want to limit your risk exposure to just the premium, you would look at a long put. If you are looking to collect premium in advance and you're not as concerned about those risk parameters, you could look at a short call. But again, remember if we're thinking about these positions in general, the long call or the long put would be the least risky because we can define our risk. We know exactly what we're spending on that premium. We know what we could potentially lose. If we're short options, those are a bit riskier. If we don't have them covered by some sort of underlying position, they could be extremely risky. And it could really cost us a lot of money in the end just to take in that premium up front. So understanding these basic positions long call, long put, short call, short put is key to understanding trading options. Now, we can combine these in a variety of different ways, again, outside the scope of what we're doing today, but this is the basis for all options trading, these four basic positions. So I know you've probably got some things to add here, Matt. Anything you want to add on to this before you start moving ahead to the next slide?
Yeah, so I mean, a lot of great questions coming in, and let me just address a couple. So one of the questions that we got is, well, who determines all this stuff, right? Who determines the expiration date and the strikes, and how does that actually look? That question is much easier to explain when we just go and pull an actual options chain. So let me hop over in Active Trader Pro, and I'll get to this here in just a second because this is going to address a couple more questions. But if you just go up to options right over here to option chain, and let's just say we're dealing with the first stock that comes to my mind, Apple. You type that symbol in. So what you'll notice on your option chain is that we have all of these weeks. Now, the expiration dates for more popular, and what I mean by popular is not that it's the best or anything like that. It's just that it garners a lot of activity. So when you're dealing with something like Apple, you'll see one pretty much every single Friday for the first couple of months. And then once we go out far enough, you'll see they'll start to skip, right? So we have one every Friday until the end of October. But then at the end of October, it skips to November 15th. And then it just goes monthly after that. But as some of these start to fall off, we'll start to see weekly expirations for the month of November as well. And that's all standardized by the OCC. And then the exchanges also can decide whether or not they want to engage in certain expirations and strikes. But the OCC, that's the Options Clearing Corporation, they're the ones that are guaranteeing or clearing all of these transactions, making sure that the assignment and the exercise goes through, making sure that if you're owed money, you're getting the money. If you're owed shares or you have to deliver shares, they're the ones that are ensuring all that stuff. And ultimately, they're the ones that are deciding the strike prices and also the expirations. But what you'll see, and right now it's blank because I don't have any expirations selected, but let's say I just wanted to go out to October 18th, and you'll notice if it doesn't have the W next to it, that means it's the third Friday of the month. And back in the day, back when Albert first started, they only had the monthly expirations, right? They didn't have the weeklies. It really only existed the third Friday of every month. So if we were to click on this one, for example, you'll see these are going to go in increments of 5 for Apple. So that's Apple, and it's mainly because it's a $200 stock. If I switched over to something like Bank of America, for example, you'll notice it still has the weeklies, but now it's going to go in increments of $1. And if we were to go here, sometimes they even have different ones. Yeah. So this one has half strikes. So this one doesn't have 38 and a half, but the weekly does. And oftentimes those get added as we get closer. So there's a lot of nuance to that question. It's a great question. But even if we were to go to something like Palantir, or actually, let's use one that I know for a fact is not going to have a ton of activity. This one barely has anybody that trades this contract. I can't even tell you the name of this company offhand. I just know it's the letter B. And you'll notice that, well, there's no weekly contracts. They only have this because there's not a lot of people that want to trade options on this. So the market makers and the exchanges aren't really interested in creating a product that they have to manage for each week and run spreads on, which is just the difference between the buyers and sellers, if nobody's really going to trade the product. So hopefully that kind of answers that question. And then if you actually go to something like an index or an ETF that tracks an index, you'll notice it actually goes up a step further. This is kind of a newer invention. This came about in September, I think, of 2022, where they have expirations every single day for the most part for these options if the market's open. So it depends on what you're trading, but it's going to be standardized and basically depending on the price of the stock and the popularity or the amount of trading volume, that's going to determine how many strikes and how far they go out. But this is all decided. It's not something that you have to submit or say I want to trade this one. The contracts are already created, and if they're active, then they're going to exist out there for you. So wanted to answer that question. And then the other thing, and we're getting maybe just a little bit ahead of ourselves, but I just like to show this in week one to start to plant the seed. If you don't get it right away, do not stress, because in week 2 we talk about buying calls and buying puts. That's the whole session next week. Week 3 we're going to talk about selling calls and selling puts. But we had a number of questions about, well, what's the difference between a buyer of a call and the seller of a put? They're both bullish, and that's correct. So if you look at this is a buyer of a call. Why? Because it's a positive one. So we would have bought to open this contract. And this is saying, for example, that I have the right to buy 100 shares of SPY all the way up until October 18th at a price of 550. Well, we're currently at 549.93. So it doesn't make sense for me to do that because if I wanted to actually buy the shares, I could get them for 11 cents cheaper in the open market. But what exists? Well, there's time. We still have a number of days before this thing expires. In a month and a half, what if SPY is now at, let's just say 600 for the sake of math? Well, now we can buy at 550 when the stock is trading at 600. That means there should be at least $50 of value on the contract. So that would be good because right now we could buy the contract for $13, which again, this is on a per share basis. So when you see this, this is saying how much you're buying the contract per share. So to get the actual amount that you'd have to spend, you slide this decimal over 2 spots. So this contract, if you were to pay the bid, would be $1,313. That's what this contract in particular would cost. So notice what also needs to happen. We need this black line as our break even. We need it to be here by expiration just to make sure we're not losing money, but we're also not making money. If we look at the opposite condition, which is selling the put, it's still bullish. We are on the positive side. It's kind of hard to see here because we spend a lot of the graph at the negatives, but we still want this thing to go higher, at least stay where it's at to make money. But notice where our break even is on selling the put. Well, we're collecting money here and we have the obligation to buy at 550. So what this is saying is if we just take the 550 and subtract out whatever we collected, in this case, $10.77, the stock could actually fall. But as long as it doesn't fall past 539.23, we're still making money on the contract. So that's the difference between buying and selling strategies. The other differences that we'll get into is with buyers, as Albert was pointing out, you have defined risk. You know, the worst you could ever do is lose whatever you paid because the worst that's going to happen, it just expires worthless. Well, with selling contracts, the call or the put, what if SPY, which it's not realistic probably, but what if it were to go bankrupt? Well, it's not infinite loss, but you're on the hook to buy at 550. And if it's worth nothing, you could sell it for nothing. You're losing the difference between 550 and again, that's $55,000 because that's 550 100 times, and you collected $1,000. So you're collecting 1,000. That's the best you could ever do when you're selling a contract, whatever you're collecting, and you're on the hook to potentially lose up to 55,000. It's the exact opposite in this case, right? What if this were to go to 1,100? You only spent 1,300 to get it. So you're kind of flipping the roles here, but in the buying strategy, you actually don't just need it to stay here. You need it usually to go higher and then some to make money. With the selling strategy, it can actually go against you a little bit to a degree, and you still make money. So that's one of the subtle differences between the two. There's a lot more that we'll get into in weeks 2 and 3, but I just wanted to start to highlight those things because the long call and the short put, you want them the stock moving higher is ideal. With the short call and the short put, you want it to go lower. And then we had a question on paper trading. So we don't have a full-on version of paper trading at Fidelity, but this tool, which I'm getting from options and then the profit and loss calculator, what this does, if you have an options position, it will pull it into the tool. But you can also add a simulated position right over here, and you can put in whatever you want to do, fill out the quantity, the expiration, the strike, call put, the evaluation price. And then once you hit apply, it will save it in here at whatever price you put in, but the bid and ask will move, and then the Theo price will move. And what will end up happening here is this changes. What ends up occurring is your profit and loss will change. So it's a way to track it, and it saves it in there until the contract expires. So if you wanted to do a version of paper trading, it's not a full-on like account, but it's a way to track positions and learn how strategies actually move in the real world. The other thing about paper trading, and I'll just say, don't love it for this reason. There's a big difference between having money, real money on the line, and having a fake account. Famously, one of the guys on our desk, he has a paper trading account, started with 100,000, and that account is at 7 billion right now. And it's a joke, right? There's no way anybody's turning 100,000 into $7 billion in a couple of years, and the reason why is because he's taking crazy risks that maybe he would have managed, maybe he wouldn't have, and it's fake. It's not a real thing. So it's not that it's inherently bad. It's a really good way to learn how a strategy will actually move. But the idea that just because you see a result of something in a paper trading account means that it's going to translate to real life trading, it's usually just not the case. So wanted to address that really briefly here. All right, let's hop back over into the DEX. So we had a question as well on the standard versus adjusted contracts, and that's what I'm going to talk about right here. So um, Nisha was asking, well, can you just repeat that standard versus adjusted? The vast majority of contracts are standardized contracts. The only time they're going to be adjusted is because the company did something that required an adjustment, such as probably the most common version of that, which is a stock split. But there's other ones. A company could be acquired, they could do a spin-off, they could do a special dividend. There's a couple different reasons why an adjustment would come down. If that were to happen, the OCC again, and this is the name right over here on the left-hand side, Options Clearing Corporation. They're going to make the adjustment. And the bottom line here is you don't have to know each and every one of these. For the vast majority of you, it's probably never even going to come up. But effectively, what they're going to do is make sure that it's fair for both parties. So whatever the adjustment is for the stock itself, they're going to make the contract reflect whatever the underlying company did. A couple things on this. You can go to their website, you can get the memo, and they'll tell you exactly what the adjustment is. Also, if this ever happens to you and it's your first time and you just don't know what's going on, that's why we have a service desk. Call our Active Trader Services number. They can walk you through the adjustment and let you know exactly what's going on. But I'm going to go through this example really quick. If they did a 3-for-2 stock split, for example, the old contract, if you had a strike price of 75 and it was 100 shares, that's $7,500. So when you do the share and the price conversion, basically you're dividing it by 2 and multiplying it by 3. That's the 3-for-2. And then when you do the price conversion, similar thing here. We're taking the strike, multiplying it by 2, and then dividing it by 3. So we get 150 and 50. You multiply those together and 75. Again, I don't want to spend more time on this because first of all, I hate the 3-to-2. It's a lot easier to explain if we have a 2-to-1 or a 3-to-1. But the idea here is that the old contract's value and the new contract's value, you'll notice that they're identical. And that's always going to be the case at the beginning of the split. Now, once the stock starts moving or whatever adjustment they did, once those different components start moving, it's going to adjust. But at the moment that it actually splits, you're not losing anything, you're not gaining anything, regardless of what side of the trade that you're on. Now, the one thing I will say is once an option does adjust, usually the trading interest in that dries up and a lot of people close them out and they go to the new contracts. Doesn't always happen, but that's kind of the usual thing that will occur. Not a lot of people are interested in trading adjusted contracts. Just a review of this again. So risk of buying options, what are you risking here option centrically that you don't get with stock? Well, the first and foremost thing, again, is time. Options have a finite life. With the stock, if you buy it, as long as that stock still exists, there's always a chance. With an option, it's going to expire in a month or 2 months or a year, depending on what expiration that you pick. If you're not right within that time, then you either have to just eat the loss or you have to usually add more capital or put more at risk in order to potentially still see a reward or a payout on that trade. So there's the time component. You have to be right within the right window. It's not good enough in a stock. Let's say you buy it, goes down for 2 years. Year 3, it comes back with a vengeance and it triples, quadruples. Great. You're participating. With an option, if you were doing a weekly or a monthly or a bi-monthly option, well, that expired how many times over the course of 2 years? You probably had to keep putting in capital and capital and capital, and it was all expiring. And then maybe if you kept doing it, you got lucky on year 3, year 4, and you participate. Maybe you get your money back. Maybe you didn't. Maybe you got yourself in such a big hole that there's almost nothing that the stock can do in order for you to make money. So that's a big risk of this. Also, the leverage, it goes both ways. Options, probably the thing that makes them the most appealing to a lot of people is the fact that there's contracts that exist that can go from $1 to $10 in one day. So that's $100 to $1,000, right, in one day. But if you also think about that, it can also go from 100 to zero in the same time. So you could lose everything. I've unfortunately seen it on occasion where somebody opens an account, has no idea what they're doing. And for example, I saw a question about if we do a contract number of one, yes, one contract represents 100 shares. You don't have to put in 100, but I've seen that before where that mistake was made, ended up spending their entire account on a very short-term option, and it expired worthless, lost the entire account. And at that time, it wasn't daily, but it was like a week, 2 week option, something like that. So don't allow that to be you. Be careful. Make sure you understand exactly what you're doing before you place the trade. And we'll cover that in the remaining weeks. This is less important than it's ever been because a lot of our systems have gone towards separating this out. And rather than doing this numerical date format, we actually tell you the month, the day, and the year. But just for anybody that may want to chart an option, you actually still have to know this. And usually there's another part here, which is you got to put a little hyphen right before the symbol. But the way that the option symbology works is the following. You're putting the underlying symbol, so SPY is this case, and then we're using 2 digits for each part of the date. So the year first, the month next with a 0 if it's a single digit month, and then the day of expiration, again, you put a 0 in there if it's a single digit day. So in this case, we're dealing with SPY as our underlying. This option would have been for January 21st of 2022, and then a C or a P, depending on if it's a call or a put, and then simply the strike price. So we know that in plain English, we have it at the top. This is a SPY option for January 21st of 2022. It's a call option, and the strike price is $208. But again, we kind of separate this, and it's more drag and drop than it's ever been. So you don't necessarily have to know this quite as much as you used to have to know, but it's always just good to cover really briefly here. If you were buying this contract, what would this mean? Well, we have the right to buy 100 shares of SPY at a price of $208 up until January 21st of 2022. Understandably, this is an older deck that we probably need to update some dates on. All right, premium components. So we already looked at an option chain, and we saw that with an option, we're dealing with a premium that is composed of two pieces. And the premium is just another term for what do we actually pay if we're buying the option? What are we receiving if we're selling the option? And it's always quoted on a per share basis. So when you see 13.01, it's not $13, it's $1,301, for example. If you saw $1 there, it's $100 is really what you're paying or receiving. And there's two parts of that premium. There's the intrinsic value. There's also the extrinsic. So let's talk about those two. The intrinsic value is the amount that the contract is in the money. So what do I mean by in the money? And frankly, I'm going to go back to my option chain because I think it's easier to understand looking at real live data. So let me pull an option chain for SPY again. And we'll pull the intrinsic here. And why don't we keep it simple? Remove some of this. We'll use 5. And I'm going to use this 550. Actually, let me do it this way, just so everybody can see it really, really plainly. Let's do one contract for right now. So with a SPY contract of 550, the price of the option is 1,264 or 1,267, between there. Notice, however, that the intrinsic value is 0 and the time value is pretty much identical to this. Why? Well, the price of SPY is $549.13. So we could buy it at that price right now if we wanted to. Our option, if we're the buyer of the call, gives us the right to buy at 550. It makes no sense for us to do that, meaning that it's not in the money, because it's only in the money if the underlying price goes above the 550. If it's not in the money, it can't have intrinsic value, so it's currently 0. But the option is not worthless because it could be worth something within the next 43 days. And that's where the time value comes into play. Time value is what you're paying for the options or the stock's ability to move. So volatility, and then also the time remaining. If I were to go out and add the November contract for 550, well, what you'll notice here when it loads is that that contract is more expensive. We're paying $1,700 for this one versus $1,200. Why? We're getting 71 days instead of 43. So the more time we get, the more time value is going to increase. But notice intrinsic is still not the same. Now let's do this. For an option that is in the money, we'll use 545 as our example. We'll notice that there's intrinsic value. Why is this? Because the price of the stock right now is higher than my strike price. So if we were to take the difference between 548.60 and 545, it should come out to the intrinsic. It's not perfect right this second because this does refresh occasionally, but when it refreshes, it'll be closer to this. We're getting in the last hour, so it's moving pretty quickly. There it goes. 362, that's right in line with where it was at that moment of download. So the difference between this and that, so the current price versus the strike is giving us our intrinsic, but the option is still worth $15 because there's still time value. So time value doesn't zero out just because we go in the money. And it's the exact same thing on the put side. Put side is, well, this put is now out of the money because we have the right to sell at 545. Why would we do that when we could sell at 548.60? We wouldn't. So there's zero intrinsic here, but there's still time value. We're to go back, and I'm just going to go back to 5 strikes so I don't have to type it in again. If we're going to go back to our 550s, so this one right here, we slide over. Well, now there's some intrinsic value because we could sell at 550, but it's at 548.82. So yeah, there's a little bit of intrinsic value, but still it's majority time value. So hopefully that's starting to make sense. That's how an option is priced. What is it intrinsically worth if we were to exercise or assign it? And then what is the time value remaining? So let's keep going here because the remainder of this is going to have to do with the exercise and assignment. And I know it looks like we're halfway through, but a lot of these examples, we don't go through all of them because once you do a couple, it's the same thing, just different numbers. But what we're talking about here is at the end of the life of a contract, what ends up happening? And if you're the buyer of the option, you have the right to exercise, but you don't have to. If you're the seller of the option, you have the obligation to be assigned if the buyer so chooses. And that's completely at their discretion. Now, whether or not this can happen early before the expiration date, that's that American versus European option thing. For almost every stock ETF out there, those are going to be American style options. They can be exercised early for index options, SP, INDX, Russell, so RUT. Those are going to be with the call. That's when the in there and saying, yes, I want to exercise my right to purchase these shares at the strike price. When you're doing the exercise on a put, you're exercising your right to sell the stock at the strike price. How will this happen? Well, do you have to call us? Do you not have to? If you want to do it early, you do have to call Fidelity in order to do that. And we basically want to check, does it make sense? Because it doesn't always make sense. It very rarely makes sense to do it early. But if we get to expiration and the option has the intrinsic value, so again, for a call, if the stock is 1 cent higher, for put, if the stock is 1 cent lower, Fidelity will automatically exercise that option on your behalf, assuming that it's not going to put you in some extreme equity situation where, you know, you're buying $1 million and your account's 10,000. We're not going to let you do that, of course. But as long as it's within reason or only, you know, slightly going over your buying power, again, if you ever have a specific situation, we don't want to, assume. We want you to call and just talk it through with one of our trading service reps to make sure that what you want to happen will end up happening. And then finally, if it has no intrinsic value at exercise, it's just going to expire worthless. Assignment, on the other hand, is the exact opposite. If you write a call or sell a call, then you're obligated to sell the shares at the strike price if the other side wants to exercise and they want to buy the shares. You have to. You have no choice in the matter. If you're being assigned on a put, that means you sold to open the put. You're obligated to buy the shares if the buyer of the put decides to sell them to you. And again, this doesn't always have to happen at expiration. It's if and when the option buyer decides to for an American style option. So it can happen early. It doesn't even have to make sense. They can do it. It's very rare for that to occur, but it can happen. And that's a risk of selling options. And we highlight that over here. So let's run through an example really briefly. So an option holder, if you exercise a long XYZ call, if the strike price was 146, what would happen? You'd buy 100 shares, but now you're buying at the strike price with 100 shares. So that would cost 100 times 146. So the cost of the trade, which you need in the account now, or at least to be able to support it on margin, is 14,600. Let's say you had 10 of those contracts. Now it's $146,000. And this will occur if it has intrinsic value of 1 cent or more at expiration. So just keep that in mind. So could you buy this option for, a couple $100? Could you buy 10 of them for a couple thousand? Yes. But if you were to exercise it, now you need 146,000. So it's very important to understand at expiration, can my account support this or not? Because if not, it might just be blocked from exercise. We might try to close it out. That's the best efforts basis, though. And again, if you're ever in that situation, just keep in mind we have the ability to talk to you on the phone about it. Not us, but our trading desk. And the other thing is you don't have to keep it to expiration. If you buy the option, you can always sell it whenever you want to. That's a common question that I haven't addressed yet. If you buy an option today, you could sell it in theory today, as long as you had enough settled cash, or at the very latest, you could sell tomorrow, right? If you're worried about trading restrictions. Let's think about a secondary example here. What would assignment look like on the same contract? Well, in this case, I would have sold the call. So now we're required to deliver 100 shares of XYZ because we're giving them to the other person. In return, we're receiving the 14,600. But here comes the question. Do we have the shares in our account? If we don't, then what do we potentially have to do? We have to go out and buy them. And depending on whether we're buying them for more than 146 or not, and then how much we collected for selling the contract up front determines our profit and loss. Keep going here. So what if we didn't already own the shares? Again, this is the same concept. We buy them at whatever price they're trading post assignment. If this is now at a higher price, 155, well, now we got to buy shares for 15,500. But again, we only got 14,600. So we're losing a decent amount. We're losing $900 on that. But we still collected a premium up front, which is going to offset that. If we collected more than $900, we still made money on the trade. We collected less, then we're losing money on the trade. And again, if this is going fast, I understand that. We're going to cover buying and selling in weeks 2 and 3. So this isn't the only time we're going to get to see these. And this time we're going to substitute XYZ 146 put for the call. So now what happens on a put? If we're exercising a put, what ends up occurring? If I bought the put, I'm now selling 100 shares at 146. So I'm collecting 14,600. But again, I need to determine, do I have the shares in my account? If not, guess what? Now I'm short shares. And I either have to buy them or continue to be short. And then the trade isn't closed at that point. If we flip it over and look at the other side of assignment, if I wrote the put, meaning I sold to open the put, now I'm required to buy those 100 shares and I have to pay $14,600 for them. And again, depending on whether or not the shares are higher or lower at that point is going to determine whether or not I'm making a profit. And again, you can start to see how leverage comes into this. What if we did 10? Well, now we're having to fork over $146,000 in order to satisfy this trade. Now, granted, we get the shares. Those are still worth something. We can liquidate those. But the difference between where we're selling and buying for, like any trade, is going to determine the profit on them. So, Albert, I know, and there's a couple more examples with European style. It's the same thing, basically just It's cash at the end. You don't have to worry about the shares. It just marks it to market. And then wherever the value of the underlying is compared to the strike, that's determining whether you're having to pay or receive cash in your account. But Albert, I know I see a ton of questions in here. I know you got to run right at 3:30. Any final thoughts before you wanted to close it up? I'm probably going to stay a little longer, everybody, to answer some of these questions, but Albert has to run right at 3:30, so I want to give him a chance to jump back in here.
Yeah, I think the bottom line is this. And again, the goal of this classroom, and specifically today, is not to say, hey, let's all go out and trade options. That's certainly not the case, right? Options will be for some people, they'll not be for others. And that's completely fine. The goal is to give you a good basis to understanding what options are and what they can and can't do, really. And then from that point, you kind of make the decision whether or not you want to investigate them further as and making them part of your trading plan. But the reason I asked the question early on is, had anybody heard that options are risky? Because that's usually the first thing you hear. And certainly they can be risky, but at the same time, they can also be a lot less risky than owning the underlying in some scenarios. And I think that that often gets overlooked because, again, I think options are a fantastic tool. Like Matt, I love talking about options. I think that they're phenomenal. It's been a part of my life for a very long time. And there's so many different things you can do with them when you get more sophisticated. And to say that they are risky just straight up across the board, that's not accurate. Yes, it can be very risky, but if you know what you're doing, it can be very beneficial to you as well. So make sure that you understand what it is that you're trading before you trade it. Much like I was telling you with those adjusted options, just even with options in general, if you're not comfortable, get comfortable. Don't just go out there and trade something when you're not sure exactly how it's going to play out or really what it could do to your potential account, right? So use this information, learn about the options. We've got 3 more weeks. We're going to talk a lot more about specifically buying and selling options. We'll talk about trade management, but use these next few weeks to really get comfortable with options and then make a decision at that point. Decide, do I want to trade options? Do I think there's a place for it within my trading plan? Again, we're not telling you have to use options, but the goal is to give you that information so you can make an informed decision on your own. So that's really what I would like to make sure that we take away from today, and as we go forward with this class, to make sure we understand what the goal here is overall.
Yeah, absolutely. And Albert, I know you got to take off here because he has another appointment, but I'll stick around. I see a couple questions in here, and I'll just go straight through the list. Had a request to show the feature for the profit and loss calculator again, and we're going to cover this more in depth in week 4. We're talking about options trade management. This tool will automatically pull in positions that you have existing in your account already. They just won't have the send button, and then you can add whatever you want. So if I wanted to sell 5 of the options for, let's go off further, April 17th of 2025, and I wanted to do the 600 strike and I wanted to do calls, I could get $869 for that contract, and I could do it 5 times, right? If I wanted to, if I had buying power to support it. So I could collect $4,345 from this. And as long as we stay below 608 by April of next year, then I'm making money on this trade potentially. But it's not as simple as that. And you'll see, how things actually move. What if we go up to 580, not 280, apologies. This is the point of the tool. And we switch it to what if that happens relatively quickly by like the first day of November? Well, what you'll see here is I'll be down pretty massively because the contracts will now be worth 15. I sold them for 8. If I wanted to buy them back and close my risk, I'd have to do that at a much higher price. I'd be losing $3,500 on this potentially, right? And I only can make 4,300 from the trade. So I'm at a pretty healthy loss right there. So this tool is, and again, we do a whole hour-long session just on this tool. We just did it this week, actually, and we do it once a month. But it's to go in there and test strategies. And once you add a simulated position, it will save it in the actual tool until it actually expires. So this is kind of the closest version of paper trading. ATP seems slow on the Mac. That's definitely true because it's a Windows-based platform and it does, some kind of boot camp operation to operate the Windows program in a Mac. There's potentially things that you can do to alleviate some of those issues. I'd encourage you, Benjamin, speak with our tech people and they can maybe work on some settings with you and some tolerances to make it a little bit better. But I know because I've used it on a Mac historically, and it works okay for certain things. There's other things that it does struggle with a little bit more. All right, let's keep going here. If the call expires in the money and it was bought on margin, will the underlying stock be bought using margin? So yes and no. It'll be done in the type margin, meaning that it'll be done on that side of the account. But if you have cash in the account to support the trade, we will use that first. So let's say you have $30,000 and your options exercise goes through and the trade costs 15,000. You're not borrowing anything there, but the shares are still going to be held on the margin side. But it doesn't mean you're borrowing. Now, if the trade costs $50,000 and you only have 30,000, we'll use your 30,000 first, and then you'll be borrowing 20 grand in order to hold the shares. So hopefully that answers that question. Can Fidelity buy and sell the stock and just give me the profit? So that's what the option is intended to do, right? You don't have to let the stock option go to exercise an assignment. If, for example, let's say we had this call for October 18th, 550, and let's say we go up to 560 relatively quick. Let's just say that happened by next Thursday. Well, now our options were 1743 and we paid 1314 for it, assuming that there's no volatility change, which is an intermediate concept. We'd be looking at about $430 profit. If you don't want to have it go to expiration, there's no rule that says you have to wait until October 18th. You can sell this option that day on September 12th. You could sell it today if you wanted to. You could sell it tomorrow. So whenever you're ready to sell it, you can do it. And that's the best way to avoid exercise an assignment if you're not wanting it to go through. How does exercise assignment work if you have an offsetting insurance contract, for example, assigned a short put of 50 with a long of 45? So it will cancel itself out depending on where it's at. So for an example, if we had a 50 short put and a 45 long put and it goes down to 40, Patrick, in that case, they're both in the money. So and we'd exercise your long put. You'd end up buying and selling 100 shares. So you'd be flat in the end, but then you're buying for 50 and you're selling for 45. So you're losing $500, but then you also collected a credit. So you're lost on the trade. You're at max loss, but you're basically your risk is limited. Where that gets tricky is if you go in between. So like, let's say it finished at 47, then you're buying the shares at 50 and you're not selling at 45, because why would you sell them at 45 when they're at 47? Doesn't make sense. So then you could end up being long shares into the weekend. So you have to be careful of that. Again, if you want to avoid that altogether, you can always just close the whole thing. What are the best practices on how long we want to go on our call and put options with the least premium paid? There's not a best practice. It's a trade-off, Deepak. So the longer you go, the more you're going to have to pay for time value, and the slower or less reactive that it's going to get. The shorter you go, the less you have to pay, the more reactive it's going to get, but you also have very little time to be correct. If you're wrong, basically one day, guess what? You're out on the trade. It's not going to work. So for most people, I would say the sweet spot they find is 30 to 60 days out. That's the most common ranges for stocks. It's getting more and more popular to go a lot shorter, but in my opinion, that's the very deep end of the pool, as our one colleague likes to say. And at a certain point, I don't want to call it full on gambling, but it can turn into that very, very quickly. So we don't encourage really, really short-term options trading by any stretch, but we don't say that there's any one particular best range or expiration date. It's really just the trade-off between how sensitive do you want it? How much time do you want to be correct, and trying to find that sweet spot between the two. With a long call that's in the money at expiration, can I ask Fidelity to buy the shares and immediately sell them? Yes. So that would be something if that happens on like the expiration day and you can't close it anymore and you're in the money. You can call us and usually they can work with you on selling the shares now. And then when we exercise it, it'll all just flatten out. If you ever run into and I'm going to reiterate this again, if you have a specific situation and you don't know how it's going to play out, that's always the thing to do, is just to call us and talk through your specific situation. But that's certainly something you can do. If you can't fulfill an assignment, then you're going to be either long or short shares, and then you're going to be in a potentially a margin call, where your balances are, you're either borrowing money or, potentially it's one of those things where you receive money, but you have shares and you're on a margin call. Uh, and then basically what we want you to do is take care of it as soon as possible. If not, then usually what ends up happening is we go in there and we'll take care of it for you. In a lot of cases, we'll actually close that risk prior to that occurring if it's going to put you in too big of a situation. On an expiring option, can you explain the timing of when the money is transferred in or out of your account? So it's always going to show up the next day. So when you pay for an option or you sell an option, you get that cash or pay that cash immediately. On the exercise, let's say you have a covered call and it goes in the money and you end up selling your shares. That money, you'll see it that hit usually that very next morning, like right there on Saturday morning, you'll see the actual cash come into your account. It's probably technically happening sometime on Friday night, but the system doesn't update it on until Saturday morning. Does long mean buy? Yes. So when we're saying long, we're saying buy to open. And that doesn't mean you want the stock to go up or down. It just means if you're long the contract, you bought the contract as the first action. So great question there, Frank. Let's see. Patrick already answered that one. When looking at a given stock ETF, how do you identify if European or American style? So stocks ETFs assume they're American. I can't think of any examples offhand that are not that way. With indices, assume the European. The only one I can think of is OEX, which is the S&P 100, but nobody really trades that anymore. That's for some reason American. But stocks and ETFs, I can't think of a single example where it's not American style. Will the recording be posted? So talked about that at the beginning. I know a lot of people came in towards the end here. If you go to fidelity.com, type in options trading at Fidelity, and then you go down until you see that link at the bottom, and we'll have a list of the videos. There's 6 of them. It's not this exact class, but it's the same class, just different people recorded it. Is there a fake platform to play around with? So this is what I'm showing you right here, this profit and loss calculator. That it's not a full-on platform, but you can put in simulated positions and track them here. Paul, hang in there with us. Paul saying, this is a lot to take in. It is week 1. It's a firestorm, and I'm sure you're not the only one that's feeling that way. It makes more sense as we start to go and break this down in weeks 2 and 3 and 4. And just like anything else, it's a language. It's all about exposure, right? I didn't get it the first time that I went through, and it took me several months to really fully understand what was going on. So we encourage you to keep coming back, and eventually you will, I think, start to piece it all together here, as many others will, as I did as well at the beginning of my options trading journey. At expiration, do I have all the trading day to execute the buy? So yes. So I'm not sure I even fully understand what the question is. At expiration, the contract, most of these, unless it's specifically stated that it's an AM contract, it'll trade up until the close of business that day. Some even go until 4:15. There's a lot of nuance to this, as you can start to see. So you could, in theory, trade out of it all throughout the day. The only thing I'll say is if it's going to put you in a really bad margin situation, if it were to exercise, our margin team might go in there and close it early. So again, circles back to, if you have a specific situation and you want to be sure, just give us a call. Should we download Active Trader Pro before the next session of this course? I think it helps. You don't have to in order to, there's people that trade options exclusively online. We use this because it streams data. It's a little bit easier to utilize. But yeah, if you want to, you just go to accounts and trade on our main website, down to Active Trader Pro. It'll get there. All right. Can you exercise a call and money without having the money in your account, but with the sell and cover, keep the profit? So you don't need the entire capital in order to be able to exercise it, but you can't be put into too low of an equity situation. I'm hesitant to start giving theoretical numbers here because every situation has its own merits, but usually if it's just a little bit over, that's going to be fine. It's not a big deal. Circles back though. If you have a specific situation, just call us and we'll tell you. Um, with long calls that are in the money on expiration, I don't have the funds to execute the buy. What happens? So the best thing to do, right? Again, with this is if you have a call that's in the money, you can always sell it. You don't have to let it exercise in order to attain the profit. So that's usually the best thing to do. But if you wanted to exercise, again, just call us and we'll talk you through whether or not that can actually happen. It sometimes it depends on whether or not you have margin as well. How do you find the recorded sessions and the homework? So the homework, you go to fidelity.com/classroom, go to the options for beginner, and then you'll see in weeks 1, 2, and 3, you click on those links. That'll be the homework. For the recorded sessions, options trading at Fidelity, just search that. It'll be one of the things at the bottom. Natalia's asking, do you cover hedging in this course? So a little bit. We talked about buying the put in week 2. We actually have a course all on hedging. I think it's next week. Give me 1 second here. I'm going to check. I know this is blanking out my screen. Let's see. It is on the 17th, Tuesday, September 17th at noon Eastern. We will have an entire hour-long discussion on hedging, but yes, we will talk about that some in week 2. If a call is just sitting in price as it nears expiration, do I have to have this to buy the shares or sell for a loss? So you can always sell the option. If you buy the shares, you don't know if it's going to be a gain or a loss depending on when you actually go to sell the shares. So that's the answer there. You can always sell the option. Let's see. If you want to sell, Kevin's asking, if you're in the money and you want to exit the trade and don't want to own the stock, would you use sell to close? Yes, that's correct. Sell to close, buy to open, sell to close for being long options. If I sell a put and the buyer wants to exercise their option, does this happen automatically or must I physically go in and buy the stock and transfer it to him? Great question. So all of that exercise and assignment will happen on our end. It's all behind the scenes. The way it works is the buyer of the option will submit an exercise instruction with their broker. The broker sends it to the OCC. They randomly sign another broker, and then the broker randomly assigns a client. So that's how that works. But once you're assigned, that all happens automatically. You don't have to go through and physically purchase the shares and send them over. Our system will do it, and you'll just be short if you don't have the shares, or you'll suddenly own shares. Can you set it so an assignment is automatically is exercised once it reaches a certain threshold? So no way to set automatically as far as exercise. You can set limit orders on options just like you can with stock sell. So if you bought this one, for example, for 13, if you wanted to sell it once it got to 20, you can do a limit order on that just like you would any regular stock. It trades just like another security would. Do you know if this tool works for credit spreads? Absolutely. So Thomas, if you go here, you just change it from calls and puts. You can do spread. You can do same thing. This is a intermediate class example, but if you wanted to see what this looked like, we'll just do this. And I'm picking random numbers here, folks. If you did this, you throw in a spread and you see how it kind of looks there. And it does it as a multi-leg. It even tells you the name of the strategy. Already hit the recording ones. At what rate does time value of options decline? That's what theta is. This is another intermediate level concept. So if you go here and we go to column, and we'll talk about this more in selling options in week 3, but this is the rate. It's not static though. It's dynamic and it gets larger for at the money options as we get closer to the expiration date. Yeah, and if anybody has specific questions where they're wanting to discuss, that we do have a trading service department that can talk to you one-on-one about all of the stuff that we're talking here, and they can talk through a lot of these concepts one-on-one if that's something you're looking to do. What are the hours of operation for Trading Desk? 8 to 5 Eastern time. And if you can call, of course, anytime, 24/7. But if you're looking for that group in particular, it's 8 to 5 Eastern. Are options buyers and sellers mostly retail investors, or are there institutional investors too? I would say it seems like it's mostly retail, but I think it depends on what you're talking about, which contract. Things like SPX and SPY, that's probably more institutional because they're going in there. A lot of times they're using that to hedge things. Do you need to own 100 shares before you trade an option? No, it's not required. You don't have to own the shares in order to trade the option. They're independent. How do you choose the contract if strike price is the same with multiple expiration dates? Uh, Nisha, we'll get more into that in weeks 2 and 3. We're trying to keep it a little bit more. You know, I know I've been all over the place here in the questions, but we'll come back to that in weeks 2 and 3. Option price determined, intrinsic value plus the extrinsic value, and specifically how's it determined? We cover that in week 1 of our options intermediate class, but the basic is this plus this equals this. If you get assigned, how long do you have to deliver? So you deliver it immediately as soon as you're assigned. Now, if you don't have the shares in your account, and then you'll be short, can you support being short or not? If you can't, then we want you to deal with that as soon as possible. So like Monday, if it happens on a Friday, um, even earlier, maybe don't even let it get to that point if it's going to put you into a massive margin call or a low equity position. What technical indicators to learn for options trading? So we're not really covering that in this class. We do individual classes on that, Waleed. We also have a 4-week class on technical analysis where we talk about some of those things. So I would reference you to go over there. Same with Active Trader Pro. Curtis is asking, do we have classes on that? Absolutely. I'm teaching that one this month as well. I think it was yesterday, but yeah, we do a 4-week class, and we have a recorded version of that. If you type getting started with Active Trader Pro, you can see that Curtis on our website. Is there certain criteria to open an options account? Yes. So you can add the options feature to your Fidelity account, but it is a separate application and there's different levels. So the different types of strategies that you can do are determined by the level, and which one you're given depends on things like your financial information, your experience with options and trading. So you fill that out, and then somebody on our end will end up reviewing it and they'll let you know what level you get assigned with. What is the number to call the options trading support desk? So our active trader number is 877-907-4429. I'll type that in for you, and I'll just put that publicly in the Q&A. Can you do a stop loss on an option? You can. We don't really recommend those for many cases because oftentimes you'll be disappointed with the execution. Sometimes it can save you. The biggest problem is options. If things get really volatile, those spreads can widen massively and the trigger could go off and it ends up giving you something that you didn't want, especially if it's not liquidly traded. This one is, but there's a lot of examples where I've seen some horror stories where somebody was doing a big amount of contracts and they did a stop loss, and then the contract should have been intrinsically been worth hundreds of thousands of dollars, and the execution was for tens of thousands. So you don't want that to happen. Although the stock was at 103 on expiration date, why was I losing money? Probably because you paid more for the contract than what the intrinsic value was worth. That's the real only explanation. Common one here as well, not understanding volatility, which is this. That's very common on earnings where you'll see somebody buy a contract at the money, earnings, the stock goes up 1% or 2%. But guess what? The volatility contracted massively because the expectation that was that it was going up a lot more than that, and you can actually lose money buying a call when the stock goes up. That is a possibility. On the rarer side of things, but it can certainly happen. And if you want to know more about that, Eli, I would say week 2 of our options intermediate. That's where you really have to understand the volatility. So my call is descending in price from strike. I won't have to buy shares, right? Just spell for it. Yes. So that's exactly right. If you bought a call and it started to lose value and we're underneath your strike price, you can sell it now and eat the loss and get back whatever is remaining on the contract. But in a worst case scenario, if it stays below your strike, it'll just expire worthless and you don't buy the shares or anything like that. You just lost the money that you paid for the contract. That would be the worst case. And that it's a benefit. It's a feature of buying calls as it limits or defines your risk. Can you always close out a short option position by executing the opposite by the trade? Yes. So if you're shorting an option, you're selling it to open, you can always buy it to close. What price you have to do that at That's the unknown. It could be significantly higher. Ask people that sold calls on, GameStop back in 2021. They maybe sold them for a couple cents, and they had to buy them back for tens of thousands of dollars in some case. So can certainly happen. All right, David. So I see your question. Can we look at an actual example? So that's not typically what we do as much in this class because it's a beginner class. We do that in some of our one-off classes where we're talking about specific strategies, or when we're doing just our one-off options sessions, our coaching sessions. We don't take a hard look at multi-leg strategies and all the different nuance. And yeah, it is very beginner. That's the whole point. So if you know a lot about options, maybe this isn't a good use of your time. So I don't want to waste it by any stretch of the imagination. But we typically don't look at these are the good options trades, right? Even in our other sessions, we're not going to say, yeah, do this trade or do that trade. That's not the point. We're trying to teach about the strategies, but not advocate for any particular leaning one way or the other. All right. That being said, we'll probably go and wrap it there. Try to cover as many of those questions as possible. Thank you all for being with us. We certainly appreciate it, and we'll look forward to seeing everybody next week.